Hey traders, welcome back to Trade Empire. Today in this video, we will show you our top and best price action signals, and we will also teach you that how you can use them for your benefits. So let's start our video after a short intro and disclaimer. Our first topic is double top and double bottom entry. A double top or bottom is a well-known M or W-shaped reversal chart pattern, commonly used in technical analysis. And this pattern is not always clean as illustrated below. It can be messy sometimes, but it does not matter that it is clean or messy. If we have to tops and price starts falling from there, then it will work for us. Here we have an example of double top chart pattern. A double top chart pattern shows that the buyers are getting weaker and price failed to create a new higher high. A double top pattern simply means that price got rejected from the same price level twice. And the first way to trade this pattern is to wait for the price to break the neckline, because it's a double confirmation that price is no longer in an uptrend. But if we trade this way and take position here, then our stop loss will be too bigger. So to save yourself from this, we have another method to trade here. We have to wait for the price to come back at this neckline, and after that we'll look for candlestick rejections. And if we have any rejection candle near this neckline, then we can execute our trade there. And now our stop loss will not be much bigger. But if we trade this way, we can lose many good trades because not every time price gives us the rejection candles. So the third and best method to trade here is to use Fibonacci retracement tool. To apply this on the chart, go to the Tools section and find Fibonacci retracement and apply it from the start of the move to the end of the move. And then set your pending order at this 0.618 level. And now wait for the price to take a pullback and pick the remaining orders. And finally we have a winning trade. But remember one thing. After applying the retracement tool, also keep an eye on the price action and candle behavior. Because sometimes price only comes at the neckline and give us any rejection candle and start moving downward from there. So if you don't see any rejection candle, then let the price come into your 0.618 level. Otherwise execute the position at the rejection candle. The double bottom chart pattern is same as the double top. But the only difference is that double bottom is valid when price is in a downtrend from a while. And the double top is valid only when price is in an uptrend for a while. So here we can see that after creating a double bottom pattern, the price also breaks the neckline. So now, we will apply the retracement tool from the start of this latest move to the end, and set our pending buy order at the 0.618 level. But we will also keep an eye at this neckline level. Because if market gives us any rejection candle at this level, we will then execute our position at that rejection candle. Now let's see what happens here. So here we can see that price did not give us any rejection candle at the neckline price level, and trigger our order from 0.618 level. But here's a question. Why is 0.618 level so important? The 0.618 Fibonacci level is important because it's based on the golden ratio. Traders use it because prices often bounce or reverse around this level, making it a key spot for support or resistance. Our next topic is fakeouts. A fakeout is when the price briefly moves past a key level like support or resistance, but then quickly reverses. It tricks traders into thinking a breakout is real, causing them to enter too early and get stopped out. Now, here's an example. Imagine we are in an uptrend and price is making clear higher highs and higher lows. And when price break through resistance, it becomes support. And if price return to this price level, we believe that the price will go up again from here. But if price break it to the downside, we call this a fakeout. A fakeout shows that the market lacks strong momentum or that big players are trapping traders. It often signals uncertainty or a possible reversal, leading many impatient traders to make wrong moves. Here on the Euro-Dollar 1-hour chart, we can see that the market overall trend is bearish. And suddenly price break through this resistance level. So now we are expecting that this resistance will act as support now, and price will bounce back from here. But the support got failed and price gets back into the range. It indicates that sellers are in control while buyers lack the strength to sustain the upward move. So now we are confirmed that this was a fake out to trap early traders. So now after identifying this fake out, we could expect the price to move downward and continue its original downtrend. Our next topic is shrinking candles. Shrinking candles refer to a series of price candles that gradually become smaller in size, showing reduced momentum and decreasing buying or selling pressure. This often signals a possible pause, pullback, or reversal in the market trend. In this example, we can see that first price came up, and then it took a pullback. So we mark this area as a supply zone, and we can see that when price come near to this zone, the candle's body gets smaller. The psychology behind shrinking candles is that traders are losing confidence in the current trend, and this hesitation can signal that the current move is running out of strength, often leading to a reversal or consolidation. So if you notice shrinking candles near a supply or demand zone, you can expect a very possible reversal from there. Our next topic is rising and falling wedge pattern. A wedge pattern is a chart pattern where price moves between two converging trend lines, either sloping up or down. It shows a slowdown in momentum and often signals a potential breakout or reversal once the price breaks out of the wedge. But how can we trade this pattern? In a bullish scenario, when price break out of the wedge, we will first look for a break of structure. It means the price must break and close above this recent high. Then we will wait for a pullback near this wedge pattern, or it can be near this break of structure line. And then we will look for any candlestick confirmation to enter the trade. Now let me show you a real chart example, so you can easily figure out what I'm saying. Here on the Euro-Dollar 1 hour chart, we have a clear bullish side wedge pattern. As we know, that a wedge pattern is an indecision pattern, so we cannot trade until price break out of it. So here we have an upside breakout by this big bullish candle, and we also have a clear break of structure, which is a solid confirmation that market will continue its original uptrend. And now we have two entry methods here. First, we can wait for a pullback and then find any candlestick confirmation. Second, we will apply the retracement tool from the start to the end of this move, and set our pending order precisely at this 0.618 level. And we will target 1:2 to risk and reward ratio. And after full confirmation, we have a winning trade with great reward and low risk. Same concept will apply. If price break the wedge pattern to the downside, we will first look for a break of structure, and then we will apply the retracement tool and set our order at 0.618 level. Our next topic is momentum candlestick pattern. A momentum candlestick pattern is a price formation that shows strong and fast movement in one direction, usually represented by a large candle with little to no wicks. It reflects strong buying or selling pressure and often signals the start or continuation of a trend. The psychology behind a momentum candlestick pattern is that traders are highly confident in one direction, either buying or selling. It reflects aggressive behavior by big players or institutions, often driving the trend further. Here on the gold 15 minutes chart, market is in a strong bullish trend, and we can notice these momentum candles at the end of almost every pullback. It shows us that the buyers are strong enough to drive the trend in one direction. So in a continuous market trend, could be bullish or bearish, whenever you see these momentum candles after a pullback, you can expect that the price will continue its main trend, and any type of reversal is not expected. Here's an important point. Always be patient and wait for your entry setup to appear. Don't rush into trades just because the market is moving. A planned and confirmed setup gives you a higher chance of success, while impulsive trades often lead to losses. So always try to focus on quality, not quantity. So guys, that's all for today. If this video has provided you some knowledge, please leave a like and subscribe the channel for more trading videos. Wish you good luck for your trading journey.